Good day, fellow crystal ballers. It is Wednesday, August 6th, 2025. We'll begin with our headline, Tomorrow's Jobs Data Could Wreck Markets. When we look through charts today, something is going to become very obvious, which is that the market is kind of waiting for the next catalyst, the next shoe to drop. And that may occur as early as tomorrow. While the weekly report of initial jobless claims has been dropping recently, and continued claims higher than it's been in years, yet not going any higher yet, the theory that I want to put out there is, remember what happened to the head of the BLS for allegedly having something to do with the jobs data looking better than it actually was with those revisions? And by the way, are the revisions even that accurate? My idea here is, powers that be, the people involved with reporting the initial claims and the continued claims, have a little fire under themselves to make sure not to make things look peachier than they are. So maybe this is the report that'll crack things, but we'll see. Markets certainly are acting like they are preparing for something big. Again, we'll take a look at the charts momentarily. Next item, only because it was pretty big in the news, talking about Apple. Its stock went up a lot today, closing at a 5% gain because of the announcement that they're going to move some of the manufacturing to the United States. If you don't think about it very much, then I guess that's sort of good news. I mean, I'm not sure it increases the value of that company by 5% personally. I'm really curious to see if it goes straight back down tomorrow, but I guess we'll see. We also had a 10-year note, Treasury note auction today. It was not a very strong auction. So why is this? Are people worried about inflation? Well, the market's not. The 10-year break-even inflation rate's been pretty low, although this isn't quite updated for today as of this recording. My theory on the issue is, why settle for, 4.25% today, which is what the auction ended up ending at, when you could just wait tomorrow and get a 30-year bond for 4.8%. After all, if the Fed's expected to cut, and then we recently got more cuts added to the Fed funds futures, plus the 10-year and beyond tend to move in tandem, well, why not reach a little further out on the curve, especially where we are right now? I'm going to go out on a limb and say tomorrow's 30-year bond auction is going to go much better than today's 10-year note auction. Just a crystal ball guess. Moving on to our community topics, what moves, if any, did you make today and why? I love reading through all of your comments and getting a sense of what you guys are thinking and what kind of moves you are doing. Today, Robschild sits on hands, does nothing. Coming up Thursday, tomorrow, that jobless claims report that I mentioned at the beginning of the episode. And I think it's later in the day we have the 30-year bond auction, which should be very interesting. Also coming up, continuous tariff updates. As long as the 10-year Treasury note yield isn't skyrocketing, we're going to put more tariffs on. That's the way I see it. And if the 10-year starts losing to the upside, then we'll back off a little bit. That's how we're going to play this game, right? That's how we've been playing it for months at this point. I expect it to continue. As always, thank you so much for watching. Thank you very much for all of your subscriptions. Thank you for your comments. And thank you especially for your support. I got some extra special support very recently. Thank you, sir. You know who you are. No changes to the Daily Reminders macro views. See my website in the description to read them. No changes to the crystal ball ratings nor the Robschild portfolio. On to the charts. What do you mean, Robschild? It's preparing. The markets are preparing for a catalyst to drop lower. What I mean is the amount of bearish volume that we had all last week, followed by much less volume and less volume and less volume as the market is rising. Meaning there's a lot more selling pressure, the larger amounts of money appear to be waiting for the moment to either sell and or short the market. Next TLT, my favorite place to be, had a very unusual spike in volume today. The volume specifically, 519,000 shares of this, representing about $45 million, all happening within 1 minute at 11:40. This had nothing to do with the bond auction. The bond auction was later in the day. And it wasn't just the fund TLT, the 10-year Treasury note yield, all the way out to the 30-year Treasury bond yield also spiked at that time, 11:40. I don't know what happened. Something happened. Maybe someone's trading computer crashed or something. Maybe someone knows and can comment below. Crude oil also really caught my eye today, cracking below that $65 a barrel level, a level that has acted as resistance. In other words, we couldn't get higher than it for many candles, and then we went above it, we couldn't get below it, and we finally cracked back down to the downside, suggesting that oil will fall further, and probably yields, since yields often follow oil. I don't think it's just the seasonality of August and September that are suggesting that markets are about to fall. I think it's a bigger event, but we'll see. Another chart that really caught my eye today was GDX. This is the main gold miners ETF. Very notably getting to, is this an all-time high? No, it was higher in 2011 when we had all that stuff going on with silver and rare earths. So the odd thing about this is that when we take up a chart of gold, gold is not at a new high. So the thing that the gold miners are mining is not like way higher. Yet the gold miners are suddenly worth so much more money. Not sure what to make of that. Considering we have a confluence of trend lines right above our heads in gold, right now around 3,400, says that GDXD, a triple inverse of GDX, starts to become an interesting idea. I mentioned yesterday I exited my short on QQQ with SQQQ because of the volume in the SPY sort of drying up as we were going higher. I said that this could easily continue, and it did, and we didn't get to the essentially 570 level yet, which I will short the NASDAQ again if we get there. Last chart of the day I just felt like talking about is XLE. This is an energy index fund. I sometimes admittedly will say on the show, hey, XLE is going up, that's terrible. And I'll also say XLE is going down, and it's terrible. The thing is, both are actually right, I think, and I'll explain. In good normal times, for example, let's say from 2023 until today, XLE is not going obscenely high or obscenely low, going kind of flat. That's good when energy is secure. What's bad is if XLE is going way up because of oil prices getting higher and things costing more, because the eventual fallout is that oil and the energy sector will crash when the crash ends up happening. XLE going up, it's like a warning sign that it's about to go right back down. Interesting that we've been so steady in sort of a historically speaking, pretty tight range for the past 3 years or so now. If crude oil continues to fall below that $65 a barrel marker, this could be the end of all this bullishness. See what I did there? Anyway, that's all from me and my crystal ball. I hope you enjoyed. Thank you for watching, and see you next time. Robschild.